Hey everybody, it's Eric Green. Thank you for joining us on this week's Tax Rep podcast. So for those of you who have not been following, I'm Eric Green. I am a partner with Green and Sklar's. We're a boutique tax firm with offices in Connecticut and New York, but we do federal tax cases really from all over the country. What I wanted to cover in this week's podcast is stuff I've already covered in the podcast, but for some reason, not only am I seeing a lot more of it, but knowing where the government is going to be going over the next 6 months to a year, I think it's critical that we highlight some of these things. And so what I'm calling this is the 3 critical mistakes that practitioners are doing when they're dealing with non-filers. So why is this so critical now? Well, as you know, we've had a number of IRS folks on the podcast, Paul Mamo being one of them. He is the director of IRS collections currently. What I am hearing, we're planning right now, as you know, we're planning for the New England IRS Representation Conference. It'll take place November 29th and November 30th. November 29th is a half-day program at Quinnipiac Law School in North Haven, Connecticut. The 30th will be all day at Mohegan Sun. And in planning for this, we're talking back and forth because the IRS executives will come and update us. And what we're hearing a lot about are the more than 7 million non-filers that they have identified. Not only identified, but are working on an initiative to go after. All right, we don't have the details of the initiative yet. I'm hoping that they are going to be announcing it either on the podcast, which has been talked about, or possibly even live at Mohegan Sun. But knowing that there's going to be this huge increase in business, right? I mean, if these people are non-filers, let me just tell you, most people who are non-filers who are found do not then file many years of returns, right? Tax due generally, 25% failure to file penalty, 25% failure to pay penalty plus interest, and say, oh, okay, and pull out a checkbook and just write a check. It just doesn't happen. So where do those people end up? Generally in the collection division inventory. We already have more than 14 million accounts in the collection division inventory. So is it possible we could see as many as 20, 21 million by the end of next year? I think it's a real possibility, and it's something I'm sure that is haunting the IRS right now. On the flip side, it's kind of like, I don't want to say, I'm not trying to make fun of non-filers, but it strikes me sort of as like termites in a house. Now we discover we have termites. If we shut our eyes and ignore it, do they go away? No, they're there, and we know they're there. So you can't just turn your back on the non-filers. So this is going to be an issue, but I will tell you this, I've gotten calls recently. A tax rep, we did a webinar on dealing with non-filers. Well, so now I've gotten calls from people who said, Eric, I had this non-filer. So we filed all like 12 years of missing returns and, with the feds, and, I gotta deal with the state at some point, but I'm not worrying about them right now. And, they've already told me 2 horrifying things that they've done. All right. So what I'm going to do in this week's podcast, right, is dope slap everybody a little bit. If you've been listening to the podcast, you know this. You're a tax rep Jedi or on your way to becoming a tax rep Jedi. You don't need to worry about this. But if you haven't, this is a good one to listen to, right? Because there are 3 critical mistakes. The truth is, there's one critical mistake that gets made, but there are kind of 3 mini buckets, if you will, that these practitioners go stepping into while trying to help non-filers. Okay, right? 1 is the number of years you're going to file. 2 is how you're going to file, right? And number 3, right, is when and where you're going to file. So I'm thinking now how to go through this. Well, let's go through the very first one. Easy. If you have a non-filer come to you, and that non-filer, right, has not filed returns for 6 years or less, you're just going to file the missing returns, right? If, however, they have not filed in more than 6 years, you only do 6 years. Okay. In the description, I will put the code section, point you to that. You only do 6 years. There's no reason to go back further. Okay. So when I get the call that, yeah, we filed 12 years, oh, why? You didn't have to. 6 years. It's in the Internal Revenue Manual. The definition of compliance, which is what we need to get people into, is the last 6 years. Okay? So you only ever file 6 years. Repeat after me. Actually, you don't have to repeat after me. But the point being is, repeat it to yourself. You only have to file 6 years. Right? After that, here's what you got to do. If you have somebody, now whether they're coming in and they're filing 1 year or they're filing 6 years, because we wouldn't do more than 6 years, if they can't pay the balance, if you do the returns and they look at it and say, yeah, I can't pay that. Okay. You immediately stop, whether it's 1 year, whether you're going to be doing the 18 return and this happens, or if you're doing 6 years, you stop. You need to go the next step. Okay. Let's pull out a Form 433 and let's go through the collection analysis. Now, why would we do that, Eric? You know, got to get the return in, got to get the return in, get the return in. Well, how are we getting it in? Married filing joint or married filing separate? If it's a non-filer, what if we want to file the state returns first? Now, if you've been listening to the podcast, hopefully a bulb has gone on. So, oh yeah, you know what? You told me about that, Eric, way back in the first episodes, right? Now, if you haven't listened to it, listen up. This is how you earn your $10, $15, $20, $25,000 for this case. You do all the back bookkeeping. You do the back returns. We get a P&L for this year, right? We need to know what the income is. But let's go through the analysis. So let's say we have a couple, and we have 6 years of returns prepared, and they're going to owe $250,000 to the IRS and $75,000 to the state of Connecticut. Let's go through the offer analysis. Now, there are two things that are going to come up. Assuming for the moment that the income belongs to both of them, they're both self-employed, so there's no improvement. Married filing joint, married filing separate, but we'll get to that in a minute. So we're definitely going to go in. Actually, you know what? It doesn't matter whether we're going to go married filing joint or married filing separate. Here's the issue: we go through the offer analysis, and they come down positive $3,000 a month. $3,000 a month. That's $36,000 a year. We have a 10-year collection statute. They can full pay. They only owe $250. Excuse me. So, as you probably know, with an offer in compromise, if you can full pay, you are not eligible for an offer. You must get into an installment agreement. They changed the rule when they did the 2012 Fresh Start Initiative. So they're going to have to pay $250. But what if? Oh, so anyway, let's follow this through. Like the person told me, they filed 12 years. They owe $250,000. We filed the federal returns. All right, now we got to deal with the state. Now, I don't know about your experience. The states are much worse to deal with than the feds. Now, I don't deal with every state, so I'm making kind of a blanket statement when I say that. I understand. But my experience with like Mass, New York, Connecticut, Florida, and California, the states that I've actually had to fight with, Illinois as well, they don't seem to care who's in front of them. See, the IRS has a statute. There's a federal statute, 6321, that says upon demand for payment, if a payment is not made within 10 days, a lien arises by statute retroactive back to the date of assessment. So the feds will take the view, their lien starts at the date of assessment. They are in first position. And that's very important because let's say we work out, the IRS set comes down with $3,000 left over on their 433 analysis. The state of Connecticut shows up and says, we want $2,500 a month. Actually, they probably want $5,000 a month, but let's say they say they'll go for $2,500. Now, if you do the 433, there's a line on there as an expense, right, for delinquent state taxes. So you would say, oh, well, $2,500, we can deduct that. No, you can't. IRS isn't going to allow that. IRS is in first position. What they're going to say is, look, you have $3,000 left over, and you owe us $250, and you owe them $75. So $75,000, right? That is what the state is owed. $75,000 divided by $325,000 of total tax debt, federal and state. The state is 23%. So we're going to allow 23% of your $2,500. We're going to allow $577. You're going to then pay us the other $2,400 and whatever. You go back to the state, they're going to say, screw you and your $576. We want our $2,500. And the client ends up between a rock and a hard place, and they can't do an offer. They're not offer eligible. But if we were true tax rep masters and we took a step back, and while they were sitting there, before we filed anything, we went through the analysis, and I came down with, okay, you're $3,000 a month positive. You're going to be able to full pay. Here's what we're going to do. What if we file the state returns first? I take the 6 returns. I mail them into the state of Connecticut, certified. You always do it certified. I get overnight. I get the green card back. Now the state is in first position. Now, for me personally, because I have enough connections into the Department of Revenue in Connecticut and New York, I will make a phone call and say, I need this agreement set up right now, or you're not going to get a dime because they owe the government, the feds, $250. Connecticut is usually only more than happy to oblige. Eric, what does the client want to pay? The client wants to pay, oh, I don't know. How about $3,000? Okay, 3,000, 12, that's 36. You'll be paid in a little over 2 years. Yeah, we can live with that. How soon can you get that to me? Give me a day or two. Within a few days, I get the fax back, setting up the arrangement. Connecticut will do that even if the returns hadn't finished processing yet, because we're desperate for money and we're Connecticut. New York doesn't move that quickly, but you can push them a little bit. So now I've got my plan with Connecticut. Now I file my federal returns. I do the 433A analysis. Now my reasonable collection potential, my future income, is 0. Assuming that they don't have much in the way of assets for the moment. Now I can do an offer for, I don't know, $1,000, $2,000, whatever de minimis there is. Maybe there's a little bit in the cars, maybe there's a little bit in the checking account. Although frankly, we could have planned for that too. So long and the short of it is a few $1,000s. I just saved the clients $250,000 by simply stopping and saying, time out, where is it? Where are we getting off at this? Where does this train end? Are we in a train wreck between the state and the feds? Or if we're going to pay the state anyway, right, because they're just assholes, that's the way they are, can we not use them as leverage to get the deal with the feds? We can, but only if we file the state first. So the next first mistake with a non-filer is you don't file more than 6 years, ever. Number 2, you have to stop and go through the analysis, the collection analysis, because you might want, the next 2 are going to be big deals. Number 2 being, do we file the state returns first? Now, there are many of you out there that say, well, Eric, on the current return, when you have to e-file, they go in together and you can't file the e-file, the state return. Yeah, I get that. How about this? We print the returns, the client signs them, and he mails Connecticut in first, or New York or California, whatever it is, waits a week or 2, and then files the feds. Now, of course, the idiot client has waited till October 14th, and now you don't have the kind of time for this. I get that. Although they haven't filed for years, what's another late return really matter? But we can't counsel them to not file a return. The point being is hopefully the client's smart enough to come up with it themselves. But the point is, there may be reasons to mail the state return first and make sure we get the state in front of the feds, because we can then use the state as leverage to compromise away the feds. And the federal bill is usually much larger. All right? The third critical mistake is, I've talked about this before, think before you file joint. And once again, if we go through the collection analysis, we may be better off doing married filing separate returns. And I've told this story many times. I'm going to tell it again. Couple comes to me. They have had horrific things happen to them. Deaths in the family, illnesses, cancer, you name it. Nervous breakdown, accidents, the works. He has a pickup truck. She formerly worked in Manhattan, so she's got about $500,000 in a IRA that she rolled over. When they had a special needs child, she decides to stay home. So she leaves the corporate world, but has about $500,000 socked away in an IRA at the time we're dealing with this. And she has inherited the home in Lower Fairfield County. It is 7 figures, no mortgage. All of these horrible things happen. They don't file for about 8 or 9 years. We file the last 6 years, get them into compliance. All right. So here's what happens. I get a phone call from a CPA. He said, look, Eric, I got these non-filers. I've heard you say, think before you file. I'm sending you the returns. I think we should do an offer and compromise form. I look, I go through it. She's got the assets. She's got $500,000 in an IRA. She's got like a $1.4 million home with no mortgage. They're going to owe about $625,000 with penalties and interest. I call the CPA back with the couple there. I said, can you file the returns married filing separate? He said, yeah, sure. So he runs them, sends them to me, calls me back. He says, it's about $850,000 now. He said, we're clearly going to do the married filing joint. I said, no, we're going to do married filing separate. He said, you're going to cost them $200,000, right? From $625 to like $850 or whatever. I said, no, I'm going to save her $625,000. Let's do married filing separate. It's not her income. She's a stay-at-home mom. She's not responsible. They cannot get her assets. He has a pickup truck, and I think he had like a $3,000 IRA. We got rid of his debt for $4,200. Right? I saved him $610,000. Now, if I could only get a percentage of that, wouldn't that be great? On that note, by the way, which was not part of this program, but I'm going to just mention this to everyone listening. You cannot, under Circular 230, do an offer and compromise and take a percentage of what you save them. It is a violation of the ethics rules, and if you have a very sharp lawyer for the client on the other, your client, they'll let you do all the work, and then they're going to inform you you're not getting paid. And they'd be right, because you are in violation of Circular 230. There are certain things that you can do and where you can get a percentage of what you save the client. Amended returns, filing to get credits for the client. An offer and compromise is not one of them. All right, go and check out Circular 230, but just take my word for it. You cannot do that. Now, number one. Number two, I don't know who would want to do that anyway. Let's say the client gave me a third. So, okay, I saved you $600,000. You owe me $200,000. How are they going to pay me? I never really understood the logic there. Am I going to get $50 a week for the rest of my life? I suppose if you have enough people, maybe, but it'd be too much work just keeping track of it all. No, you can't do that ethically. Right? But what I hope you take away from this, when it comes to dealing with non-filers, 3 critical things. 1, you have to file the back returns, get them into compliance, but do not do more than 6 years. You do not have to. Number 2, well, then there's a big number 2, which is you have to stop. If they can't full pay it immediately, you have to stop and go through the collection analysis, or what I like to refer to as the offer analysis, right? The 433. What does the resolution look like? Right? Once you've done, and once you've done that, now you know the answer to the next 2 things. Do we do married filing separate? And do we file estate returns first? One more caveat. For those of you listening in the 13 states that are community property states, the community property rules may not make that married filing separate, married filing joint work. All right. Let me just explain. The reason I can't give you a definitive answer is I was amazed to find out how different the community property states are. There's opt-in states, opt-out states. It's a little bit of a mess. And the Internal Revenue Manual has a whole area where they just discuss this. The point being is that when it comes to whether you can do married filing separate and shield the assets of the non-liable spouse in a community property state depends upon which state you're in, right? And I'm not going to pretend to be some sort of an expert on community property states. All I know is if you're in a community property state, you got to look at the rules because that may very well impact that strategy. All right. So hopefully what you got out of this, I know it's a short one this week, but this is something, I wasn't planning on this. I was actually supposed to have a guest. The guest doesn't look like he's going to be coming on until later in the week, so we'll probably post that next week. However, having gotten now like 3 of these calls in the last 3 days, it's ruined my weekend. I felt like I really just wanted to get a message out there and reiterate this, right? Because it's very important. So with that, keep building your practices. I want everyone to keep representing people. If you haven't joined us yet, please do. All right, November 29th, November 30th for the New England IRS Rep Conference. You can come in person, although I think the seats might be sold out. You have to go check the website. We're very close to the room, 300 seats being gone. But there's always the live webcast. You can certainly join us live from wherever you are in the world. All right, last year we had all 50 states and 16 countries people on. All right, so it's very cool. Come join us. Even better than that, you want to build your practice, come join us inside Tax Rep LLC. We'd love to have you as part of our community. All right, so keep building your practices, keep making money, keep saving taxpayers' lives, and I'll talk to you later in the week.